Very good afternoon. Welcome to Mutual Fund Corner. I'm Nigel D'Souza, and as we speak, we're having a good run in terms of the Nifty. We're moving to the high point of the day. Good to see. After a not very great financial year, the end of the year, the closing is pretty good with the Nifty up close to around 4%. Global cues have been fairly stable, and that's good news actually. And after the kind of dropping that we saw in yesterday's trading session, we're bouncing back, and that's good news. For the time, we're holding about the 8,620 odd mark, which is good news. And importantly, if you're looking at the put data and the put writing data, that as well is looking quite good. The 8,000 put, that has the highest open interest. It added close to around 8 lakh shares odd, but that number has been more or less constant. What's encouraging to see is that there are signs of writing at around the 8,400 put, 8,500 put as well. Between them now, you have nearly around 15 lakh shares odd. So the bulls will be feeling quite good that maybe at around 8,300 odd, we could see the first level of support that is likely to come in there. Remember, in terms of levels, 7,511, that's a crucial level on the downside. That appears to be a near-term bottom for the Nifty, so we'll keep an eye out on that mark. And with the 8,000 put having a highest amount of open interest, you'll definitely keep an eye out on that one. 100-month moving average at around 8,430. That's going to be the first level that we'll be tracking as well. So Nifty doing well, but we're going to be answering all your mutual fund queries. So let's get in our guest. We have Harshvardhan Roongta of Roongta Securities, who joins us to answer all your mutual funds queries. Hey, hi Harsh, thanks so much for joining in. We have a first query that's coming in there. Ramya, in fact, is on line from Hyderabad. She wants to invest around 10,000 to around 15,000 rupees per month and wants recommendations on the same. She also wants to know if the ULIPs are better than mutual funds. Well, that's the query that's coming in. So Harsh, if you could help out Ramya with her query.
Well, Nigel, if you talk about suggesting some investment, we need to know a little more than just the amount that a person wishes to invest. Like in this case of Ramya, we know that she wants to invest about 10 to 15,000. But we don't know what is the time horizon that she wishes to stay invested for.
No,
what is she investing for? So that is a goal.
Right. So Harsh, let's get that clarified. Then what is she Ramya, I believe that you have joined us on the line. If you could clarify, what are your objectives?
Like, I'm looking for better future funds, like mutual funds. Like, I don't have any portfolio.
Okay.
So you could suggest me like mutual funds in debt and equities, so that I will go with it.
And your time horizon would be?
Like long term.
Long term. All right, Harsh. Any further queries you have for Ramya so that you can help her out, and help her in building this portfolio?
Oh, well, I guess this is sufficient enough when she says that she's building a portfolio for long term. So, Ramya, what I suggest is, because you have a long term horizon and you don't really have any other investments right now, you could allocate this money, which is 10 to 15,000 rupees, in a 100% equity fund. That is ideally for a period which is in excess of 8 to 10 years. So, if you can stay invested for 8 to 10 years minimum, then of course equity funds. In that, you can most certainly have one or two schemes to the extent of about say 4 to 5,000 rupees in a balanced fund, which is a hybrid aggressive fund, which would also have some bit of debt in it. So this is purely from a fact that you're investing from long-term perspective. I want to, before I get into the scheme recommendation or anything of that sort, I want to clarify with you, because you raised a query about ULIPs and mutual funds. What's the comparison between the two? So, well, I'll give you the nuances of each, the benefits and, you can feature, so you can basically evaluate, and then I'll give you my suggestion as well. So, ULIPs will have an inbuilt life cover associated with it. So, when you have a life cover, say suppose you're investing 10,000 a month, so that's 1,20,000 a year, you will have a life cover of about 12 lakhs, 10 times of what you're paying. So you will have to pay a charge for that life cover also which you're getting. So if you don't really require a life cover, there's no point in going in for a ULIP policy, because you'll be paying a lot of costs which you don't really need to pay otherwise. Now ULIPs also will have a lock-in period of 5 years. So when you invest, you cannot move your investments out of at least the insurance company that you have. Scheme, you can shift from a balanced fund to an equity and all that, but you cannot leave the fund. You cannot leave the insurance company. So you will be stuck with that insurance company for 5 years at least. Whereas in case of mutual funds, if you take a non-ELSS, ELSS has a lock-in for 3 years. But other than that, you can shift your money across different fund houses if they are not performing well. Now, a great advantage for a ULIP is that all the proceeds that you receive at the end of your maturity, which is 5 years, 10 years, 15 years, whatever, will be tax exempt as per current tax rules. Whereas in mutual funds, when you're investing, there will be a long-term capital gains which will be applicable. So these are some of the features. One more thing that you would need to keep in mind is with in terms of transparency, in terms of serviceability, mutual funds are far, far more superior than insurance policies. So when you look at comparisons, don't say, why am I highlighting these details, Nigel, for even the other viewers? Because all viewers, all people are approached saying that the proceeds, maturity proceeds in insurance policies are tax-free, wherein you have to pay tax on investments in mutual funds. So only one point is highlighted, whereas there are all other points which are always kind of suppressed or neglected. So my earnest suggestion is that for Ramya as well, for investment purposes, stick to mutual funds, despite there would be other some restrictions in mutual fund in terms of capital gains tax that you have to pay. But considering the overall picture, it is better to have investments which are segregated from insurance. So mutual funds is a route that you can take. In case you need a life cover, then of course term plan is there. Now answering her specific question of where to invest is 10 to 15,000 rupees. Well, divide this into say I take an example of 10,000, and then she could, if she's investing 50, in the same ratio she can invest. So a 50% of this, so which is about 5,000 a month, should go into large caps. So within the large cap, you can invest 2,500 into an index fund, which is an IDFC index fund, the Nifty plan, and the other 2,500 can go into an Axis blue chip fund. So in this way, she will have 50% of her money going into large caps. The balance 30 to 50%, she can just simply invest into two schemes. One part would be a conservative fund that I'm talking about, some bit of debt in it as well. So an ICICI equity and debt fund is one option, and the other could go into a multi-cap fund. A Kotak standard multi-cap would be the option. So 50% gets divided into 25 each. One is a hybrid aggressive fund, which also has some debt part in it, and a multi-cap fund, which is a Kotak standard multi-cap.
Okay, all right. Well put, Harsh. Thanks so much for clarifying those queries. I'm sure, in fact, Ramya has got a lot more clarity on her query. But let's move to our next query. We have Mr. Ron Coutinho, who writes to us from Mumbai. He has investments in multiple funds and wants to assess his portfolio. His goal is long-term wealth creation. Well, Harsh, those are the details that he is given. I can fill you in with a few more details. He's retired, he says, and some funds I think that he does hold as well. He's mentioned out there, Robeco Emerging Equities, and a couple of others as well. How could you help him out?
So, well, I have looked at the query, Nigel. So, the decision that he is making is right. So, what he is essentially saying that he's got about 4 or 5 funds that he wishes to retain, and the other schemes that he has, he wants to just, because they're non-performing, they're not aligned with his larger goal. So, what he's saying is that he wants to redeem out of those funds and just consolidate his portfolio into the 5 schemes that he wishes to retain. So, the decision is right, and the process that he's adopted is also right. So, we do come across so many queries wherein people have like about 15 funds, and then they realize that I know that's not what should be there, so I want to consolidate it. If he's doing that, it's completely fine. So this consolidation process can go on as it is, and he has a concern whether I'm exiting out of schemes right now when the market is low and I'm buying into another scheme. Is that the right strategy? So if he's exiting from the market at these levels, also he must remember that he's immediately moving into the performing schemes at the same market level. So it's just shifting from one equity fund to another equity fund. So market levels become irrelevant. So he can most certainly go ahead and do this kind of a consolidation in his portfolio if he wishes to. Just one suggestion that I'd like to give him, because he's retained 5 out of his existing schemes. I would like to make one change there. He's retained the Nippon Small Cap Fund. So I would ask him to drop the Nippon Small Cap Fund and instead retain the HDFC Balance Advantage Fund, which he already has in his portfolio, which he was planning to discard. So I'm just repeating it for his benefit. He can drop the Nippon Small Cap Fund and retain the HDFC Balance Advantage Fund. The rest part that he's planned is perfectly fine. He can go ahead with that.
Well put, Harsh. Well, I'm sure Mr. Coutinho would be gaining from all the advice that you've put out for him. But we have another query that's coming in, and this time from Bengaluru. We have Pavitra Mani, who writes to us from Bengaluru. She has investments in multiple funds and wants you to assess a portfolio. She also has a lump sum of around 10 lakh rupees and wants advice on how she should be investing. Interesting one, Harsh. How can you help her?
So she wishes to stop the investments that she's making into the HDFC Small Cap Fund. Well, I endorse her decision on that. And yes, she can most certainly go ahead and stop the investment that she's making in a small cap fund. And instead, she can add another scheme in her portfolio, which is the Kotak Standard Multi-Cap. Now, if you notice, she has about 10,000 rupees that she's investing in an SBI focused equity fund, in which she's investing 10,000. So this is also a multi-cap, but it has a concentrated portfolio of about 25 to 30 companies only. So there is room in her portfolio to add a diversified multi-cap, and which has more than probably 30 companies in the portfolio. So Kotak Standard Multi-Cap is a suggestion that I give to her. The rest of her portfolio, which is ICICI Nifty 50 index fund, is of course an index fund and a good one, so you can continue with it. And the Nifty Next 50 is also good, which she can continue. So there's only one change that I recommend, which is in place of HDFC small cap, add the Kotak Standard Multi-Cap. Now, with regards to the lump sum of 10 lakh that she has, and the concerns are right, the markets have corrected about 30 to 35% right now. So most certainly the valuations look attractive. But at the same time, I'd also like to say we do not know what is going to be the bottom. So nobody would be able to predict to say that whether the markets are bottom right now. And at the same time, we would also be anticipating that we're looking at some kind of growth prospects with this money. So the ideal way would be to split this 10 lakhs into a staggered manner. So you could do a 5 installments of rupees 2 lakhs each, and probably just put up a timeline for yourself that every month I will put 2 lakhs at lump sum besides the SIPs which are going, so that I can take advantage of the fall in the market. So I think that's the strategy she could apply. Divide this 10 lakhs into 5 installments of 2 lakh rupees each, and every month for the next 5 months she can invest in bullet payments of 2 lakhs. And the schemes that she has in her portfolio, she has 4 schemes in her portfolio already, just divide this 2 lakhs into those 4 schemes and invest it that way.
Okay, all right, Harsh, thanks so much for addressing that query as well. So we've addressed a few queries. Let's take a short break. You come back, we'll continue answering all your mutual fund queries. Stay with us.
BSE Star MF.
Holding comfortably above that 8,600 odd level, but we have been answering all your mutual fund queries. So let's get straight to our next query that comes up for you, comes up for you on the screen. And we have Mr. Hitendra, who joins us from Ahmedabad. He has investments, I believe, in ICICI Prudential, All Seasons Fund, and wants some advice on the same. Hi, Mr. Hitendra, thanks so much for joining in. Tell us what's your query and how can Harsh help you out?
Yeah, good afternoon, Nigel and Harsh. I have invested as a part of my emergency fund. I have invested in some amount in the ICICI through All Seasons Bond Fund.
Okay.
Now, at this point of time, I don't need this money, and currently it is giving me a return of around 9 to 10% per annum. So I don't need this money. I'm good. I can continue. The only concern that I have is, given the current turmoil that we have in the equity market, and equity markets on that, what will the effect be on the dynamic bond funds in general, and this fund in particular? So that is the first part of the query. The second part is, I also had some investment in a couple of Franklin India schemes, and I have burnt myself because of the Vodafone Idea papers that were downgraded. So all my bonds were wiped off. I'm just a bit concerned if something of that sort might happen on this ICICI Prudential All Seasons Bond Fund.
Okay,
so
all right.
Should I continue or should I redeem and get whatever I am getting right now, sit tight for about a year or so, and then invest again?
Okay, Hitendra, that's a detailed query that's coming in there. Just a piece of advice from my end that this market's a teacher. You keep learning, and in fact, ultimately, you get to your goal. So don't worry about the mistakes that have happened. For the time being, we'll try to address your query. We have Harsh who joins us. Harsh, I think pretty detailed query. Could you help him out?
Yeah, so in fact, Hitendra, you have a very valid concern. And in fact, this market turmoil has segregated and separated the men from the boys. So you rightly, identified that you've invested in the ICICI All Season Bond Fund, and that returns on that scheme still is about a 10%, wherein you've seen negative or almost all returns being wiped out from your Franklin India schemes, which also has the Vodafone papers. So let me put this to you that ICICI, has also invested in papers of SL and other companies. But they have structured their deal with the promoters so well that they've done full recovery as of today. So they haven't had any default yet. So as I said, the current turmoil has actually separated the men from the boys. Now, this particular bond, all seasons bond fund is a dynamic bond fund, as you rightly identified, and the duration of the fund gets modified based on the interest rate outlook. So with regards to the movement in interest rates, I don't think you should be concerned because the dynamic bond fund manager already does that for you. So, and the portfolio composition of the bond fund that we're talking about is primarily in a AAA rated portfolio with about 30 to 40% invested into AA rated papers. Given how they've managed the crisis for the SL and all other papers, and considering the AAA, primarily a 70% or an 80% almost with a AAA and some portion in about AA, I think could most certainly consider continuing with this one without any hesitation. What you need to redeem out of will be the Franklin investments that you have, if any.
Okay, all right. I think that pretty much addresses the query that came in there from Hitendra. Well, let's move on. We have Prathamesh Bhatt, who writes to us from Mumbai. He wants to review the investments in his portfolio, and I think we should get some of them up for you on the screen. Yep, they're all up in the screen. Harsh, I believe you have the list of his investments. How can you help him out?
Well, Nigel, I look at his portfolio. So these are like all SIPs he's been doing since 4 years. And the 3 schemes that he has, I don't see any reason to make any changes. So, why disturb something that is going on well and for a reasonable amount of time already? So he has an ICICI, he has an Aditya Birla Sun Life Frontline Equity, an SBI Blue Chip, and a Canara Tobacco Emerging Equity, all from different segments. So I think he most certainly can continue as it is.
Okay, all right, Harsh, thanks so much for stopping by. In fact, detailing all those replies to all the queries that we got in as well. Look forward to touching base with you later this week as well. But we've got a stock market to look at. It's the final hour of this financial year. As the ticker tells you, we have more losers than winners in this financial year, but it appears we're bracing for a triple century on the Nifty just on the last day, which is pretty good news. And on the Nifty Bank, it's relatively underperforming. That's up only around 2%. The Nifty is up more than 3.5% odd. So the Nifty Bank, a relative underperformer, but for the time being, that as well is up close to around 400 points odd. No worries in terms of the breadth of the market. 3 stocks that are advancing for just 1 stock that's declining. So good going. Let's see whether or not we can hold on to these gains on the final day of this fiscal. On that note, we'll wrap up on the show, but you do remember to email us your queries and we'll address them with our experts. You stay with us now. Closing bell will take you through the final hour of trade.